Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we're going to be talking about SoFi Technologies, Palantir Technologies, Tesla, and Mullen Automotive. The first article we will be analyzing today is titled, What Analysts Are Saying About SoFi Stock. After that, we'll move on and talk about what analysts and professionals are saying about Palantir Technologies regarding their latest news updates and price target, and then we'll move right along to talking about Tesla's TSLA shares and how the recent vehicle price decreases have not done enough to put them ahead of competition over in China. And then lastly, we'll talk about the three main reasons why I still do not invest into Mullen stock, why I have been right in the past about Mullen stock pertaining to its falling share price and how it's a falling knife, and how you should be aware of this risk even if you are a Mullen stock investor. So for more videos just like this one on SoFi Technologies, Palantir Technologies, Tesla stock, as well as Mullen, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. SoFi, if you didn't know, is a fintech company or a financial technology company that operates an all-in-one inclusive digital app which gives their consumers access to various financial services and financial products. Essentially, SoFi operates as a completely digitalized bank, and analysts' sentiment for SoFi hasn't really changed over the last few months, which is actually good news, and here's why. Of course, we are experiencing a banking crisis right now, and the fact that analysts haven't really changed their perceptions regarding SoFi Technologies is good despite this financial crisis. So in the near term, there seems to be somewhat of a disconnect between what investors believe this company is worth and how the analyst community views this company. Investors are being very skittish and scared right now, and they are selling some of their SoFi shares, while the analyst community literally has not changed on any of their positions, and we'll discuss their point of view right now. Currently, SoFi Technologies has a current consensus analyst rating of a moderate buy rating, meaning that it's a pretty good buying opportunity right now, because according to 12 professionals, 7 of them say to buy the company, 5 of them say to hold the company, and none of them say to sell the company. So overall, these are pretty strong recommendations. Even if we were to hold this company until they become profitable, which we will talk about later in this video, it seems like a pretty good risk to reward opportunity, as long as you don't overexpose yourself more than a 5% portfolio allocation. I personally only have a 4% portfolio allocation for this particular stock. As price targets go, the consensus analyst price prediction for SoFi stock is around $8.42 per share, which would represent and equate to 46.6% upside for investors if they decide to invest right now. However, that is going to be the average price consensus. We have a low-end price prediction of $6 per share from a more bearish analyst and a $13 per share high-end price target from a very bullish positive analyst. One of the most bullish positive analysts is actually a Mizuho analyst who reiterated his buy rating, and he believes the company should be worth around $9 per share, and how SoFi is currently on target to meet that price prediction over the next 12 months. However, I do want to say that this expert provided little to no commentary regarding the current banking crisis that is happening right now. However, he believes that SoFi is completely independent from this banking crisis, and it honestly should not affect them fundamentally. The professional goes on to list a couple reasons why SoFi should not be looked at as a part of this banking crisis, and how this banking crisis will not negatively affect SoFi Technologies at their base level. And the first reason he cites is that they are more focused on short-term loans, meaning that they have low duration risk in the rising interest rate environment. And since they have more individual deposits and depositors, where the vast majority of them are covered by FDIC insurance, it lowers the risk significantly of a bank run, this company going out of business, or this company taking on unnecessary risk or overexposing themselves without a proper pool of liquidity to fall back on, which signals to us that SoFi still has a promising future despite the financial crisis that is happening right now in the macroeconomic economy. Now, I do want to say something about these analyst ratings. Just because the average analyst rating is positive to where there's 46% upside potential left in the stock over the next 12 months, according to these professionals, there is no guarantee that this stock will actually surge to that price point. You always need to make sure to do your own research. However, many analysts believe this is plausible because SoFi is still on track according to their current growth trajectory trajectory to achieve GAAP profitability by quarter 4 of 2023. And if they achieve that, just like what we saw with Palantir Technologies, their share price will increase at least temporarily as they pass this gigantic milestone. So if you want to hold this company at least into quarter 4 of 2023 until you get that surge, then feel free to do so, but always make sure to do your own research. Up next, we're going to talk about Palantir Technologies, and if you don't know, Palantir Technologies makes custom AI and machine learning applications for both large government agencies as well as commercial enterprises. I've said this a couple times before. Back in 2022, Forrester Research named Palantir a leader in artificial intelligence as well as machine learning platforms. And this came on the heels of another rating back in 2021 where International Data Corporation ranked Palantir as the #1 AI software platform for market share and revenue, which is extremely exciting. However, with that being said, this would only be relevant for aggressive investors, because even though aggressive investors may find this company to be undervalued, meaning it's a great buying opportunity, especially in the AI segment, due to Palantir only penetrating around 1.6% of their overall addressable market, which is estimated to be over $119 billion, it shows that this company still has a future runway of fantastic growth. So if you are an aggressive investor, you need to understand the risks of this company being extremely risky in the short term, but it could have massive potential upside in the long term, meaning 5 to 10 years from now. So again, I wouldn't advocate more than a 5% portfolio allocation for this particular stock. But what's interesting about Palantir Technologies is what analysts, professionals, and experts have recently said about this company. So a William Blair analyst gave Palantir an underperform rating, meaning that Palantir is not the best buying opportunity right now, considering that its current share price is around $8.21. However, he also issued estimates for their quarter 1 2023 earnings, coming in at 0.00 earnings per share. For quarter 2 of 2023, their earnings are supposed to be 0.01 earnings per share, and for quarter 3 of 2023, their earnings are set to be 0.02 earnings per share. Lastly, to round out the entire year, their earnings could go as high as 0.03 for the fourth quarter of 2023, making their full year earnings per share come in at around 0.07 earnings per share, while this is set to actually increase for the full year of 2024, where they're supposed to bring in for the full year of 2024 10 cents per share in regards to their earnings. So although this is not super impressive, we are still seeing earnings growth, which is positive. Despite this though, Citigroup analysts have recently issued a sell rating and a $5 price target for this company. Another institution such as Deutsche Bank dropped their price target on Palantir Technologies from $7 down to $6, and they also have a sell rating. D.A. Davidson has a neutral rating for this company and a $8 price target, while Wolfe Research lowered their overall rating from peer perform, meaning that they're supposed to track with their overall peer group, to now underperform, giving them a $4.50 price target. Lastly, we have a Jefferies Financial Group analyst who used to think Palantir was a buying opportunity, but now he rates it as a holding opportunity, and he also dropped his overall price target from $9 down to $7.50. So at least on an analyst perspective, this company seems to be experiencing major volatility over in the short term. And this is another reason why you shouldn't overexpose yourself to risky singular growth companies, but I would love to hear your thoughts down below on that. I just want to keep you updated on that. Overall, in the long term, this company still could work out, but in the short term, anticipate that the share price could drop even further below $8. Now let's talk about Tesla's TSLA shares and how recently Tesla has lowered their prices of their electric vehicles across their portfolio, but how this is still not good enough to beat BYD over in China. As you know, Tesla has recently decreased the prices of their electric vehicles, but it seems that Tesla needs to drop the price even more to compete with Warren Buffett-backed BYD. Currently, Chinese automakers are on track to sell more passenger vehicles than their foreign rivals such as Tesla for the first time in 2023. Chinese consumers have responded very favorably to these price cuts, but the price cuts weren't good enough, considering that new models by BYD are not only cheaper, but also are outselling certain Tesla vehicles. BYD sold more than 5 times the number of units that Tesla did over in China. And this is a reason why Bill Russo, which was the former head of Chrysler in China, commented this, and I quote, "Foreign brands are clearly bleeding market share, and we therefore expect 2023 to be the first full calendar year in which local brands outperform global brands in terms of sales volume." End quote. Meaning that BYD is aggressively taking market share away from more international brands such as Tesla. A BYD chairman even said on Wednesday that he expects the first quarter sales to jump 80% year over year, which is really going to put the hurt on their overall competition, which is great news for BYD, but it's really bad news for Tesla overall. They also anticipate to report more than a 400% surge in net profits, bringing in around $2.4 billion. I also want to say a 26-year-old engineer who works over in China says, and I quote, "I feel like foreign branded cars are all relatively high priced." And essentially, this engineer describes how foreign car brands seem relatively too expensive compared to domestic brands over in China, so why not buy domestic brands? So although Tesla's price cuts were actually good and has increased demand, I think they could get even more demand surging if they cut them a little further. However, clearly this would negatively impact their overall margins, but if your demand increases more than your margins fall, you are actually making more profits. So I would love to hear your thoughts down below. Don't forget to also research BYD, NIO, as well as Li Auto over in China. But overall, I'm still a huge fan of Tesla. I believe Tesla's share price right now coming in at around $194 per share is undervalued. I think this company could easily reach $250 or more by the end of the year, but we're just going to have to wait and see. Lastly, let's talk about another electric vehicle maker, which I've never been a fan of. You can literally look at my first video that I've ever done on Mullen because I predicted that the share price would absolutely crash. When I talked about Mullen, the share price was originally around 30 to 40 cents, and now it's worth only 10 cents. So literally, it has dropped so substantially. So I'm going to go over 3 reasons why I still am not going to invest into Mullen Automotive, ticker symbol MULN. Now, if you want to invest into clean energy companies, feel free to do that, but I don't think that Mullen has a proper risk to reward ratio, and here are a few reasons why I think that. First, let's start off with their lawsuit. Mullen Automotive recently bragged about a recent distribution deal with a Chinese auto manufacturer. However, they decided to leave out how they have previously engaged in legal battles with that same Chinese automotive manufacturer. In terms of the overall settlement, Mullen ends up having to pay around $6 million plus warrants which allow the Chinese auto manufacturer to purchase up to 75 million shares of MULN stock at 110% the price of the common stock. On top of that, Mullen will have to pay an additional $2 million for deliverable items under their intellectual property agreement. Lastly, Mullen will have to pay them a royalty fee of $1,200 for each K-50 it manages to sell in the United States over the next 5 years. So Mullen has to dish out money to this other Chinese automotive manufacturer, even though Mullen is not a Chinese automaker. And if we consider that Mullen is deeply unprofitable and already has financial troubles, this just screams unnecessary risk and how investors should stay away due to this point. The second reason I'm not going to invest into Mullen as of right now, don't get me wrong, I will invest into Mullen if they prove themselves, if the company becomes profitable, if they have a really good manufacturing and delivery numbers, and if it seems that there is a big market for this type of car and technology, but right now I just don't see that. So the second reason why I wouldn't invest into Mullen and how I've been right is that they have shady business deals. Recently, Mullen Automotive's management had an agreement with a group whose CEO has been charged with insider trading by the SEC, which is the Securities and Exchange Commission, which is very bad. On top of that, Mullen's management is also shady, making multiple promises that just haven't happened. For instance, the CEO promised that they landed a major Fortune 500 company as a client, but these updates have never been released and they still haven't been revealed, even though this has been going on for many months now, and there has been no news updates on this because it's fictitious. They literally made it up. Lastly, Mullen stock is in danger of being delisted, and this is why I still think they are going to undergo a reverse stock split. Right now, Mullen stock only trades at 10 cents, but to be listed on the NASDAQ and to be compliant with the NASDAQ, you need to have your share price over $1. Mullen was given a 180-day extension, but clearly Mullen's share price is going lower, not higher, so I don't think they're going to be able to meet this $1 criteria, but instead of the company being delisted from the NASDAQ, I believe management will issue a reverse stock split, causing originally the share price to go up, even though it's not going to add any shareholder value, and then short sellers are going to push it back down. So honestly, right now, Mullen is a lost cause, and you should wait for this company to prove itself before you decide to invest. But I would love to hear your thoughts across the board on SoFi Technologies, Palantir Technologies, Tesla, and Mullen. Remember to go and annihilate that like button for more stock market news updates just like this one, and I'll see you in the next YT video.